I've always been interested in researching who has information in markets, and so in capital markets, who has the information, who gets that information at price. So all my research is really kind of centered on insiders, informed corporate insiders, institutions like equity institutions, pension funds, etc., and security analysts who follow stocks. And so this topic was just kind of an outgrowth of that kind of a thing, looking at who knows things. And corporate insiders we've known for years that they kind of know a lot about what their firm is going to do, stock price is going to do, and we're just trying to get down to, well, what kind of information do they have, and what kind of information are they using? What we'd looked at in the past was the idea of insiders using earnings information. And so we kind of showed in the prior paper that executives, when they're buying, it usually means that annual earnings coming up in future years are going to be good. When they're selling, just the opposite. And the thing we were kind of looking at, though, was that you don't want to do that too much. If you're someone who's very visible and you have to report your trades to the Securities and Exchange Commission, you don't want to look like you're trading too much on information. You get in trouble for that. And so we wanted to see if there was a limit to this kind of relation between trading and future earnings news that would be imposed by legal litigation risks. So the idea that if I use my information too much, I'll get in trouble with the SEC. And shareholders could sue, the SEC could pursue us. And so we want to kind of look for this limit and see if, as news got really large and more visible to regulators and shareholders, that I stopped using it as an insider. So that was kind of the objective, was, do we see that kind of limit to the use of information by insiders? I think the main findings for the paper are that when you do look at the use of annual information by insiders, so buying ahead of good annual news in the future and selling ahead of poor news, the main finding was that that relation tails off when the news becomes very extreme. So if you have pretty good news next year, you want to buy on it. However, if the news gets really large, your company is just going to do really, really well relative to other firms and relative to the way the firms performed in the past, you don't buy as much. And in fact, if the news gets too good, you just don't buy at all because it's too visible. The same thing with selling. And in fact, it's more pronounced for selling and option exercises, because if you have really bad news coming up, it's very sensitive legally to be trading on that. And what was surprising was that that holds true even after you kind of look at how predictable the information is. So one objection raised when we talked to people about the paper was, maybe this really extreme news is something you can't predict. Or maybe it's something that's so transitory that no one cares about it. So we tried to control for that and look at cases where it was very predictable and very important news coming up. And even there, you still saw this relation dying off when the news got too large. And so we were able to kind of show that it really seems to be a legal litigation story, that when people are worried about getting sued or getting pursued by the SEC, that's where they stop using their information and try to pull back. And so we were able to kind of take the general idea of insiders using information and show where the limits are and show how those limits are driven by the legal environment that the insiders operate in. I think one of the large implications is that the legal environment really does work, it really has effect, and the reason that's kind of somewhat important to document is that a lot of the work done in insider trading hasn't found much of an effect from changes in the laws, for example. In the 1980s, Congress passed several laws that kind of strengthened the penalties in insider trading, and yet in insider trading, the volume continues, insiders continue to make abnormal returns to their trades, and so I wanted to kind of document that there is some kind of an effect, that legal litigation risk and the laws are having some kind of an effect. So kind of one of the implications that just comes up that people can kind of look at is that, yeah, insiders do curtail their behavior when litigation risk becomes very high. And we kind of need to document these things before we can start getting into the debate over, do we need more regulation or less? It's very common for people to say, well, we need to strengthen laws, insiders are doing things that we don't want, but there's often very little documented evidence about what's the effect of the laws we've already passed. And until we see some effect from those, we won't know what we need to do in the future. And in addition, just kind of having an idea of how much of this is going on, how much use of information is there by insiders. We need to document those things before we can actually start getting into the debate over this. And this is something that I think is relevant for many of the debates that happen in capital markets today. Hedge funds are becoming more talked about, and people worry about hedge funds and wonder what they're doing, what kind of information they're using. These are all debates that we need to get information on before we can talk about them. current research that I'm working on, a lot of it's related to this. One thing is something I alluded to before, is just the idea of what insiders are kind of doing at the firm level, what companies are doing to kind of limit their insiders. And what we show over time is that insiders tend to try to trade only at times where there's no obvious news coming out. And firms will do this. They'll have these trading windows that they put on their insiders and say, you can't trade before an earnings announcement. And that's a very obvious way to kind of prevent an insider from trading at a time when they might know something that the rest of the market doesn't know. And so I've got research showing that over time that's gone up. And there is some evidence that's related to some of the laws that have been passed. And so again, kind of documenting what do the laws do that we've seen. But along with that, that research also shows that insiders continue to earn money. And so it's narrowing down, but not fully answering what kind of information they use. So that's one of the things I'm doing. And some other research that's related to that is just the idea of looking at what happens when other informed participants kind of get involved in the market. So for example, when security analysts start following firms, how does that change the flow of information in a firm's prices? And same thing with institutions coming in. So those are the type of other things that I'm working on at this point.